next topic, we'll be listening to Ron William on the current stage of the investment roadmap. Ron is the founder of RW Advisory. He's not only a certified financial technician, he's also a neuro-linguistic programming practitioner and has more than 20 years of experience in market and mind strategies. I'm going to welcome Ron.
Hi, everyone, and thank you also to Pepperstone for organizing such a useful and insightful market discussion. I've been speaking with the other two speakers, kind of comparing notes and identifying what our key themes are. I'm sure we'll hear more in the panel discussion to follow. So the theme of my session is, what are the opportunities and risks in a world polarized by fire and ice? The language I will speak is markets, but markets through macro and technical blend. The advertised title has been changed. New report that I published recently, and I thought it best to be on point and on topic for the session today. So, brief background on myself, 20 plus years in the markets, working for leading institutions, focusing on macro technical strategy, and in the last 10 years, setting up my own independent firm, doing advisory, education, and recently coaching. I do a lot of this work globally in terms of the regions of the world, currently in the UK, previously in the Middle East and Asia. Okay, so the key points to focus on today. Starting line, it's similar to, I think, each of the speakers, a little bit about the approach that we all apply. Mine is blended, top-down, macro-tactical. There is this key principle that I've learned all my life, but more so when I was in Asia, about crisis opportunity. What do we do when things are really difficult? COVID-19 was a case in point, 2020, but then also last year too, when the market shook up many of the trends that we love dearly. And as Zahir very interestingly said, but the trends didn't love us back either. Tesla, I think, was the example that you picked. So I'm going to talk about crisis opportunity, talk about how using cycles is one way of improving our edge, not just from a market strategy point of view, but also from the actual psychology side of things. If we can see the exhaustion of a trend, might not always predict it, but if we can prepare for it, then we can do so in terms of market strategy and also mindset. Then we'll focus on the theme of my presentation, which is fire and ice. What is the story behind that? And an actionable kind of ranking and scoring method that gives you the current trends that are moving right now, global cross-asset. That will draw up key insights, which I hope and encourage all of you to remember. First one, inflation higher for longer. That is what the structural reversal that happened last year is screaming out loud. So I know a lot of us, and there was a big consensus view that inflation was transitory. Charts are suggesting that they're more stickier than that, and it's a secular rolling wave of volatility in inflation that we have seen and will continue to do so. The best analog that I can suggest to you is the 1970s, not from a macro perspective, but from a pattern point of view, in terms of the actual pattern of no direction, but with a secular trend up. Then a focus on what that does to currencies, of course, devaluation of most currencies, and we get this argument between hard assets versus paper assets. So the money in our pocket is unfortunately losing value day by day, but some currencies more than others. It is truly a race to the bottom. So we do need to be thinking about how we can offset that from a portfolio perspective, but also in terms of alternative assets that can hold better value. The dollar, which did so well last year, is one of those trends that anyone that traded it made money and loved. But of course, that has since reversed. It is a top in process. Right now, we've had a short-term relief rally year to date, and that is now rolling over as we test a key resistance level, which I will share with you. That will continue to unravel the risk-off sentiment, which I foresee for the second half of this year. So we started this year exact opposite, risk appetite. And a lot of the echo themes that we saw last year repeating again in the last few weeks. But clearly, There's been a shakeout recently, risk aversion, and part of that reason has been the hawkish comments from central banks, what that means for higher rates for longer, but also what that does to equity markets as sentiment shifts from up to down, giving back year-to-date gains, and that famous 200-day moving average that all chartists used, including myself, worked for a while until it stopped working, and the market is currently rolling down beneath it. I'm not saying that it's not a viable signal, it is, but we shouldn't be too trigger happy every time the market moves above and below it. And as I heard one very smart and veteran technician in the States say, we also need to look at the cause of the technical signals, technically and generally, because that will give you a story as to whether that's going to be a sustainable signal or whether it will fail. And in the case of what happened recently, it failed. I read Bloomberg stories about the bullish cross signal on the S&P 500, and many of the news wires that focus on technicals had similar insights, but how reliable was that signal? So we need to really ask ourselves thought-provoking questions, not just to play devil's advocate, but just to be careful and to prepare for either scenario, one that works in our favor and the others that don't. And then just to end, I do want to make the point that was also echoed by Zahir in terms of top-down process. So index, but also sector, the rotations that happen. And clearly the big theme was growth, mega cap, and that era is basically over, partly because of the rise of interest rates. Doesn't mean that tech won't lead, it just won't lead as much as it did before. It'll lead less. FANG down 50% is a case in point. We had a relief rally year to date. Now that's rolling over. And that's something I want to point to each of your attentions because that's part of the story. But if you follow it top down from big picture index to sector, and then obviously stock level, if you think about the stock constituents of FANGs, Facebook, Apple, Netflix, and Google. And that's a global story, not just in the US, in terms of the rotation from growth mega cap to value. So interesting to see some of the stock values that were presented were defensive. Healthcare I saw as part of the rotation into defensive, but also into value. Value doesn't work all the time, so you do need to look at it as on a chart perspective to make sure that there's an objective risk-reward there. And lastly, investment scenarios for fire and ice. It's a metaphor, but it's a metaphor that's used by many investment banks right here and now. I believe Morgan Stanley's published a report on this, just basically highlighting the polarization that's happening in the market and why prediction is working less, but scenario planning is working more. And I'm a big believer of both, but increasingly the scenario side of things because it's more preparation than it is prediction. Okay, so my approach. It's this cycle of three different factors. First, and most important, the top-down blended approach. A lot of people say, hey, I know that you do technicals, you study the charts, and the answer is yes. I'm a big ambassador for the work, in both professionally, but also for the technical analysis societies around the world. But I do it from a macro lens. I like to blend the best of all worlds. And so when I do that as what I call a triad approach, macro, fundamentals, technicals. Technicals is the key driver ultimately, because that's what leads you from beginning to end for trade or investment execution. But also allows you to understand the behavioral tendencies of human beings that drive markets. And I'll say it a different way. People drive markets and emotions drive people. So we really need to be studying the chart in order to study everything else. That is through a blend of quantitative and qualitative analysis. So I'm more on the qualitative side. I do like to look at the chart and see the big picture, but I'm human, can make error, and things do take time. So for that reason, I always use computers and design my own algorithms just to give me some kind of guidance. The second, in my opinion, is the most important thing in both life and markets. Timing is everything. But it's got a real bad reputation. I've heard so many different institutional experts say, market timing only for the experts, don't do it, high risk, not worth it. And there's truth to that. But I want to be very clear, market timing doesn't have to be picking tops or bottoms. It's as much about trend identification as it is about risk reward, as it is about relative performance. Market timing can mean different things. And if you know what the good and bad times in the market, your risk management will win out. And I've had many successful investors and traders tell me that risk management is way more important than selection. Doesn't mean that you select poorly. It just means that you pay more attention to the risk side than you do on the entry and even the strategy. So I do that through cycles, and there's a framework of cycles which I'll introduce. And then last but not least, a trend ranking model, because trends is what makes us money. It's the high probability direction that most people back, even if they don't call it trending or technical. And I do that global cross-asset, looking at sectors, stocks, but also factors in terms of momentum, volatility, and other areas that we can look at. If you want to learn more about the approach, there's a book published by The Economist called Mapping the Markets, authored by my mentor, Robin Griffiths, that will give you a more in-depth. It's a small, easy read, but one that I recommend. Okay, so the roadmap cycle is what you see on the slide. Essentially, it's an asymmetric shape of behavior, investor behavior. That asymmetric shape is typically what happens in a market cycle. So the way I describe it is you have the mountain climb up and the cliff drop down. That's what happens typically. Now, it's often in the equity market, not so much in commodities or currencies, because there's a different shape to those markets. But generally speaking, it's greed up, fear down, and fear tends to be greater than greed in terms of the speed and the shock factor that happens. Now, right here and now, where are we on this roadmap? We're between this late stage cycle, W, X, and Y. It's been very difficult to predict. Again, prediction is harder nowadays. Preparation is more important. And partly because we keep getting these relief rallies from oversold conditions that look like they're about to make record highs in terms of the equity market. Some markets do, others don't. And then ultimately we get the reversal down and a waterfall decline that has happened many times in history. Now, I'm not giving you a doom and gloom Armageddon presentation. That's the good news. But I do like to speak truth. And so it's really important that we manage expectations in terms of risks out there and prepare for them accordingly so that we don't have such a big adrenaline ride through difficult times. That we can be more resilient, we can have clearer minds, and we can have better strategies. Oh. Okay, now if you wanted to break it down, this is my attempt to do so, and this is what we guide clients through on a regular basis, particularly on the institutional side. It's the blended approach of macro, fundamental, technical. But if we break it down into a step-by-step rotational process, we begin with economic macro growth, fundamental valuation, and then we spend most of our time looking at technical, quantifiable filters. Essentially, that will take you through a stage-by-stage business cycle, early, mid, late, into recession, which is where we basically are now. There's all this kind of, for some weird reason, recession is now, I mean, it's no surprise that recession is in the headlines. What's weird about it is it's the most anticipated recession in history. If you ask the people who are now predicting recession, who didn't think it was going to happen last year or before, they're focusing on soft recession as opposed to hard recession. I'm not in that debate, but what I would prefer to encourage you all to do is to prepare for either. And more than likely, given that the market's been pumped up so much, it will likely be a hard recession. Any predictions of soft recessions, A, haven't happened, and B, have resorted to the latter and not the former. In that kind of scenario, you do need to be thinking about wealth preservation, defense, selection on maybe government bonds. Certain currencies used to be the dollar, but now I think things will rotate, especially after the outperformance they had last year, driven by central bank hawkish policy. That baton is being passed on, not completely, but tactically onto other safe haven currencies like the Swiss franc. Japanese yen has had a very different story, but it may become a safe haven again in the short term. And currencies aside, of course, gold is likely going to be better for a risk diversifier, not in terms of absolute performance. So my polite comment to all of you is to try to not look at the absolute performance in gold just because it's been so weird in the last year or so, going sideways and then up and then down. But as a safe haven, it still proves its worth. And then lastly, if you're going to look at sector rotation, defense is something to keep in mind where you can get some of those big winner outlier trends. Now, the actual cycle framework, I'm going to quickly fast track through for the purposes of time. This is the cycle framework of some of the key cycles. This is where most people look interested, but the reality is they're not going to study each of these cycles one by one. But I'm going to challenge you all to at least pick one cycle that might be of interest, depending on what your objective is. The top one is not the one you're going to make money from, but you're going to understand what's happening in the world around you. The bottom one is how you can make money through actionable and tactical strategies. So take your pick. The top one tells you why interest rates are now rising and not falling after 40 years. Because the average cycle, which still exists despite central bank intervention, is 60 years. And I'll demonstrate the proof of that in a chart. And it correctly predicted that this phenomena, this sea change phenomena, was going to happen last year. Not precisely, but it gave enough preparation for at least myself and people that follow the work and this cycle to prepare. Then you have the business cycle, average 10 years, and then below that, the presidential cycle that matters this year because we're now in the US midterm presidential election. That tends to be positive for policy and for voting sentiment, although that's an all-time extreme low, but something we should pay attention to because it tends to impact the market. And then lastly, the one that will make you money, seasonality, actually understanding the seasons, not of the weather in the year, which I know in the Middle East is summer, 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 but if you come to the UK, we get different seasons. And those seasons apply to markets. And I don't mean weather seasons, that was just an example. I mean in investing and trading seasons. So start of the year is a good one. How we start the year is usually how we perform and end the year. That works sometimes, but not all the times. It's not a signal, it's just an indication. What is a more high probability signal is that September and October are the weakest and the worst months in the market. And if you avoid those months, not completely, but watch the chart and have good risk management during that time, you will likely either preserve your capital or make more money by entering or exiting around that time. Okay, here's the evidence. So according to several reports from many different banks, this is Goldman Sachs, it shows that risk management alone, capital preservation, but risk management in particular, including market timing, including cycle analysis, can really be useful to your portfolio. The light blue line is what happens, not when you own the index. I know most of you are thinking that. It's what happens when you miss the 10 worst days in the market. Just 10. I've seen the same chart done another way. If you just miss 5 days, similar straight line up. Now, I had a university student yesterday look at this chart because I was presenting for a professional education group, said to me that at university, he saw this chart, but in an academic paper, and the university professor removed the light blue line from the slide. And I looked at him and I said, why would your professor do that? He said, because they were teaching me that buy and hold was the outperformer. And that is the second line in the chart. If you just buy the index, you will outperform. But if you miss out the light blue line, you're not going to risk manage that outperformance and you'll probably lose some, if not all of what you made. So again, I'm supporting the education framework, including academia, but not if you take out the truth. The truth is risk management really matters. And here's an interesting point. Last year, fear of missing out was, not last year, 2021, 2007, before we've had any market shocks, there's usually a big run-up and acceleration in the market. That's when fear of missing out is the strongest. Immediately after fear of missing out, guess what happens then? Anyone want to guess? What's the opposite of fear of missing out? So it's a new term. I think it's an old one, but it's been revived. FOLO, fear of losing out. We're focusing more on the risk side than we are on the reward. So this last chart tells you that FOMO isn't an issue, because if you miss out the 10 top days in the market, you're still going to underperform risk management and you're still going to underperform the index. So don't get me wrong, we'll still feel FOMO, but fear FOLO more than FOMO is what I'm trying to say. Interestingly, this is echoed by US investor and big mogul Warren Buffett, he says in this picture here, predicting rain doesn't count, building arks does. He's alluding to the biblical reference to Noah's Ark, predicting that, being told by God it was going to be the end of the world and there was going to be a big flood, so build an ark in order to save people and humanity and animals. Risk management matters. I would repurpose that and say the edge is blending both prudent risk management and some kind of high probability predictive system. There's no reason why you do one and not the other. Do both. But make sure if you're going to do one more than the other, risk management is up there on your priority list. Clear? Good? Okay. Quick word on the cycle edge as to how cycles can help you do that. And before I go there, I want to just make the point that people often don't trade the markets, they trade their beliefs and values. This is where psychology is the 80-20 part of the success equation. How you think is how you trade, put simply. So I'd like to do a quick survey on what your perception is of volatility. I'm going to give you 3 choices just to keep it simple and fair. Opportunity, risk, or uncertainty. So those of you that vote opportunity, raise your hands. There we go. We'll get some smiles as well. Okay, there we go. Good. Thank you. Risk. Okay, put your hand up once. I'm making sure we don't get double votes. Okay. Well, if you see both.
But you have to be very careful. You can also run up a very big loss.
Absolutely. So it's a double-edged sword.
Yeah, that's it.
Yeah. Okay. Uncertainty. Okay. Did anyone want to put their hands up twice? No, because some people do. They believe that it could be one of the different factors all at the same time or at different times. Okay. So whatever your answer was is ultimately what's going through your mind before you place the trade or the investment. There's no right or wrong, but just be aware of what's going on in the head because those voices will lead to your decisions and ultimately the final outcome. Now, the philosophy of risk and opportunity or crisis opportunity is quite interesting if you travel to the East. I was living in Hong Kong for a few years. Now I'm full circle back to the UK, and I like to learn from my travels and from the cultures of the different places that I visit. In Hong Kong and more specifically in China, the way they write the word danger is very similar to the way that they write the word opportunity. Literally one brushstroke difference is the variation of the two. And this was discovered by former US President John F. Kennedy during the Cuban Missile Crisis, not too dissimilar from the geopolitical tensions of the current time. He said, the Chinese use 2 brushstrokes to write the word crisis. One brushstroke stands for danger. It's a real thing, and we do need to pay attention to it. The other for opportunity. The punchline is, in a crisis, be aware of the danger. Don't ignore it. Standing in front of a moving train is not a good idea. But don't get blindsided from the opportunity. And unfortunately, this is what happens time and time again. And the reason for it is it's not because we're not following the right strategy or we just have a bad day. It's because it's programmed into our head from birth for evolutionary reasons, to stay alive and to evolve. We have this aversion to loss, fear, being wrong, just how we are. Now, I used to be taught by market and psychology experts, nothing we can do about it, it's fixed, just accept it. How many of you agree with that? Okay, some of you do, which is perfectly fine. It is fixed to a level, but there are certain ways that we can better manage and optimize it. That's what I'd like, that's the middle ground I'd like to suggest to everyone. It's not some fatalistic program that we have, and there's nothing we can do about it. And there's a lot of leading research in the space of trade psychology, behavioral work, and also neuroscience that is now proving this. Now it's no longer a case of, is this true or not? The research is there. We just have to learn how to practice some of the insights from that research and actually transform the way that we trade, but also transform the way that we live. Okay, so this is why we make the worst mistake at the worst time. This is an academic study that was published by Daniel Kahneman, behavioral finance expert who won a Nobel Prize for this diagram. It shows an asymmetric relationship between risk and reward. That's why there's more of this statistical distribution on this side versus the top side. What that means is that the pain of loss, and I'll say this slowly and I will repeat it, not because it's not clear, but because I want to make sure everyone remembers. The pain of loss is twice as great as an equal gain. So here's the repetition. The pain of loss is twice as great as an equal gain. So what that means is if you were to lose $1,000 or whatever currency, 10,000, $1 million, and you've made back that same amount, you're going to focus twice as much on what you lost than what you gained. And I go through this all the time, not just with myself, but with clients and with traders that I help on the strategy side and on the coaching side. It's just how we think. Some people more than others. Some people are more loss averse than others. But this is, a little bit of research as to why that happens. For that reason, we do the opposite of maximizing gains and minimizing losses. We do the opposite. We maximize losses and we minimize our gains, which is clearly not trend following. For institutions, under-allocate at market lows and bottoms, over-allocate at market highs and tops. And what's interesting is that I'm focusing on the risk side of the equation, but the reality is either extreme is a problem. And so the opposite side is what? Greed. So greed, fear of missing out, is also problematic. It leads to addictive behavior, irrational exuberance when we tend to bet the bank, and usually have a risk of ruin. That's the technical word for losing our money. And it's a big issue. And clearly in bull cycles, this is why the cycle itself overruns, because we've hit an extreme of either side of this behavioral equation. So I truly believe that through education, we can be more empowered. Now, education doesn't change us. What we do with the information is what changes us. So I'm going to give you the opportunity, invite you all to learn, be aware, but then also have a think about how you can include this in your approach so that you can be better at markets. Now, one of the famous quotes from, again, the same person, Warren Buffett. There's lots of other experts that I could quote, but he came up a few times on my screen for having good quotes, is that we should be fearful when others are greedy and greedy when others are fearful. How many of you have heard that saying before? Okay. How many of you had been successful in doing that? Okay. Same answer I get for the most part. Some people can do this, but usually the strategy is what helps them to do it better. And more often, I speak to people who are trying to do this, but they haven't quite worked out how. I probably fit that camp too. It's not a perfect world out there, and human beings, are prone to error and behavioral bias. So it is what it is. But one idea that I would suggest is cycles. Just by understanding that trends don't last forever. Yes, they can and are our friend, but nothing moves in a straight line. And the insight I developed a while ago, and I was discussing it with one of the speakers, is it's this feeling of being in love in life and in markets. It's a good thing, but if it's blind love, whether it's a trend or whether it's a brand name or whatever metric we look at, that's the issue. When we become irrational, we make the mistakes that we could have avoided. So cycles is a way of reminding us that markets don't move in a straight line up or down. They do cycle. Sometimes they go sideways as they're shifting from up to down or vice versa. But it is the mean reversion side of markets that we need to remember. So according to the cycle work that I've been doing for years, based on lots of testing, but also composite cycle work, we're in worse times right now. So again, I said I wasn't going to be doomsday or Armageddon, but I was going to speak truth. And this is showing global sentiment at a historic extreme, lower than we were in 2008. Now, what's interesting about this is it did correctly predict 2008. Not that we were going to have a global financial crisis, but that we were going to have a shock in the system. Again, it didn't predict in 2020 the pandemic, but it did tell us there was going to be a shock in the system. The difference in the two is that the shock of 2020 was bigger than 2008. And I remember in 2008 when I didn't have this model perfected or tested as it is now, thinking this could be the end of the economy as we know it. People were talking about recession and maybe depression. Didn't happen. Central banks worked the way out. China boomed, and the rest is history. Here and now, just keep in mind that whatever happens, because we don't know what will happen, what this is telling me, and what I'm saying to you, is that it will take more time for things to repair and recover. The average bear market is 2 to 3 years. That's the time duration of the average big bear market, not mini bear market. COVID 2020 was a health crisis, but it wasn't a traditional bear market in market terms. I joke with clients that you could have fallen asleep during that crash if you were able to. Wake up, market has gone up, 1/3 of the move you would have lost. And that's why fear of missing out was so strong, because people really did miss out part of that move. That was an outlier event, shock event that we don't usually see. Bear markets are longer in time, but also bigger in price magnitude, usually about 30 to 50% in price terms. Okay, I'm now going to end on my final slides on the theme of fire and ice, but I will be a few minutes over, so I'm just going to quickly get an indication from our organizers, if that's okay, just to complete the presentation, and then we'll have time in the panel to discuss more. So fire and ice is the big theme that I reframed the market story to. It's based on a poem that was written a long time ago in the US about difficult times in the world and what was going to be the fate, fire or ice. You can look up the poem by Robert Frost. It's there on the screen if you want to read it. But essentially, it's a good metaphor for markets, the rotation of sentiment, risk appetite, and economic growth and contraction. It also helps to understand why so many experts have been wrong in the latest cycle, because there is no one direction to anything. It's this free-flowing shift of polarization, yin-yang energy, fire and ice, inflation, deflation, bull trend, downtrend. It's this constant rotation of all of these things, and the rotation itself is speeding up. So it becomes even harder for us to follow and predict. The way that I try to simplify it is through models, as well as market analysis. And so the global cross-asset model that I use looks across different time frames: long-term, strategic, medium-term, tactical, and short-term active. And what that does is assign a color to that asset class, whether it's equities, commodities, currencies, or fixed income, and tell me what's doing good and what's not. What it shows is that risk aversion as of the last few weeks is now intensifying. That's why you see pink up top, US 10-year yields elevated after central bank comments that were relatively hawkish. And now we're at the highest level this year, back at the previous October peak levels, around near the 4% mark. It also shows that as part of the risk aversion, there's a shakeout in equity markets, specifically USA in blue. But here's the interesting point. There's a divergence in performance between the US and the rest of the world. So it's not a one-size-fits-all. If you're a little bit downbeat by the bearish view that I shared with you on that cycle chart, the good news is it won't be for all markets. Some will lead a recovery while others may lag. And right now, the big lead is world versus US for the first time in years, but also China. And China, of course, is a big part of the reopening theme. Again, living in the area, I can tell you after 3 years of extreme restrictions, it will have an effect when things reverse the other way. And a lot of people, friends of mine as well, are talking about revenge spending, revenge consumption. Whether or not it's viable and sustainable, we will see. But the key thing is it's been a big impact in markets. And for those of you who are a little bit concerned about trading China, you don't have to. Look at the impact of China to the world and think about China proxies in terms of commodities. Think about how China reopening might be positive for world markets, even the US, in terms of offering a cushion to any recessionary pressures. There are stories in there that can be supportive if it continues to prevail. Right here and now, based on markets, there is a dislocation. And some markets are outperforming the States, and risk aversion is taking place. And then the final themes, inflation higher for longer. This is why. If you look at, I think I was just talking to Wissam a while ago, and He very interestingly said that pictures matter, and we all know this, the statement, picture speaks 1,000 words. This picture speaks even more. This is why there's a secular rise in interest rates, a cost of living crisis, and ultimately why there's a generational change happening right now. Based on long-term interest rates, this is a look-back period of 200 years. It shows that cycles do happen, 60 years on average, 30 years up and down. This latest reversal in the downtrend of easy money took an additional 10 years, partly because of central bank loose policy and all kinds of other structural reasons. But the long story short, it reversed. And I'll share with you the reversal in a moment. So the first point is cycles matter, and they drive one of the most important things in our lives and markets, interest rates. Second point here is that the average high watermark of interest rates is 5%. So all this 3%, 2% lower may happen, may not, but just keep in the back of your mind that the average is 5% and maybe higher if we deviate. Ask yourself how your portfolio can beat an inflationary environment and why it's important to be considering that. Not just last year or this year, but generally. This is the price action right here and now. You can see the big breakout from that secular downtrend, 40 years down. Multiple generations of one market going in one way, and it affects everything. Cost of money, mortgage rates that we use our credit cards, all of that stuff. Central bank policy. The range is likely between 5% and 3%. That's as predictive as we can be with what we will see. The 1970s is a good analog because that shows you that we have rolling waves of volatility, not up or down. It's just rolling waves of volatility, but the general trend is up. And right now, this is the risk aversion trade that is happening as long-term rates break above the December peak high into the 4% handle with 4.2 nearby. These are the peak levels that were already happened last year. We're just headed back in that direction, and not just in the US, but across global bond markets. Okay, next theme: US dollar king of rock and roll. After the famous rock and roll star, highlighting the fact that the dollar was truly king last year, but as it rocked up, it rolled down, and there's an asymmetric shape to that trend too. Because of a major top that is currently in process. You could have predicted this ahead of time if you studied charts. So a fellow shout out to the chartists here that do look at charts, speakers, but also maybe members of the audience. This stuff really not only works, but it really works well during challenging markets and macro pressure points that we're in now. Here you can see that the trend was strong, but it was overbought, divergent from momentum indicators. Lots of historical studies were saying that we were at massive extremes of about 20% or so. And if and when that happens, systemic risk usually kicks in. And positioning in terms of institutional money was overcrowded, hasn't fully unlocked. That's why I'm half sure about a market top, and I think there's still downside to go. That's the dollar signal. When relief rally that we now have is testing the channel that we carved out into the top of last year. What happens next is going to be key. So watch your charts and think about what the move on the dollar potentially down will do to the currencies that you hold or the markets that you trade. And then just lastly, I'll end on seasonality. Remember, this is the market timing technique that can make you money by picking out good and bad times in the market. You can see here a quick study by a fund in the US looking at how predictive it is. And the last 3 years, if you just looked at how the year started, it would be useful as an indicator for how the performance would prevail. 2022 started bad, ended bad. 2021 started good, ended good. 2020 was very unusual because it started good, we had a health crisis, market crash, and yet it ended positive. It's not as easy as it looks. You do obviously have to have more market color, whether it's macro or technicals, but generally speaking, it's a useful thing to keep in mind. Where I think it's going to be very strange is this year, because we started the year really strong, and the headlines were really positive, and people were feeling really good. And that's a good thing. If you feel good, continue to feel good. But be prepared for surprises. The positive surprises we start the year strong and we end strong. That's what this chart shows statistically. Positive trend up, negative trend down in this side and that side. The other parts of this quadrant are when you get a surprise in either direction. During times of volatility, the surprise is usually to the downside. So that is likely a scenario for the rest of the year. You can't trade this, but it's something to keep in the back of your mind. What you can trade is the price analog of 2008 versus now, not the same one-for-one pattern and definitely not the macro overlay, but what it does show is this very interesting overrun in the trend above the long-term moving average, big correction of about 20 to 30%, retest of the average, and then a sucker signal where it pops above the same line. We get all excited, and then it switches exactly the opposite direction, which is what then creates the self-feeding down cycle. So this is an old chart looking at December last year. January was positive. It broke above this key 4,100 level on the S&P 500. But as we all know, live, and I was sharing live screens yesterday, we're now rolling lower. This is the latest price action as of today, retesting the 200-day. I don't want to give the 200-day or any other technical well-known signal a bad name, but don't be too trigger happy because there are times when it works and times when it doesn't. Here's an example of when it doesn't. And more important than the 200-day was this key level at 4,100, which we failed below. The next risk level is 3,600 at the October low, which gave us the previous liftoff. And then following chart, other levels that I'll close on. From a sector perspective, one of the reasons why the S&P 500 and equity markets in general have been up year to date is because the old bull market themes reappeared again in the short term, only for a temporary amount of time. And that's what we see here in the FANG index, so the mega cap growth tech names, having a relief rally from oversold conditions after a 50% drop. 50% drop. They will still perform, just not as much as they did before. And now that relief rally is rolling over, potentially below the 200-day. Based on sentiment studies from Bank of America, it's the two least underweighted positions in the market. So a lot of people have downscaled their positions in this sector and might be a reason why it's still vulnerable. Okay, and then the last charts on China showing post-COVID recovery is currently what's being forecasted. The recovery is likely not going to be even. If you look at the broad-based index of the CSI 300, it's a healthy unwind from extremely oversold conditions, that's this chart. But if you look at mega cap growth in China, it's looking like it's about to fall off a cliff. So it's not just bearish mega cap growth in the US or even anywhere else, also China. So you still need to be very selective, and stock selection is probably a great strategy to be learning now, because you will need to do a little bit of extra work, not just buying the index. Okay, that's my presentation on approach, fire and ice, key market insights. Thank you very much for your attention. Thank you. And we'll take questions during the panel. Just as a final word, if you want to stay in touch, also social media, LinkedIn in particular, I post when there's thematic or timely things to share. And this current presentation I'm giving is part of a mini roadshow of Market and Mind, starting in Switzerland, then into the UAE, and next week Singapore. So if any of you have friends in the area, let me know. Happy to say hi. Thank you.